If oil goes to $200 a barrel, the real damage will not come from the number itself. It will come from what the number destroys. That is the first thing I would tell you. The second thing is even more important. Most people think a crisis begins when the news becomes dramatic. I think a real financial crisis begins when one variable rises high enough to make the old story about everything else impossible to keep telling. That is where I believe we are for the last stretch of this cycle. The market lived on a very fragile fairy tale. Inflation would cool, the Federal Reserve would cut, borrowing costs would ease, high multiple stocks would justify themselves, consumers would bend but not break, and all the stress that had piled up under the surface, private credit, commercial real estate, government debt, unprofitable growth, overstretched households, would somehow be carried gently into a softer future, because the price of money would eventually become kinder again. That was the story. Oil above 100 already begins wounding that story. Oil racing toward 200 does not just wound it, it burns it down. That is why I do not think this is mainly an oil story. It is a chain reaction story. It is a rate story. It is a margin story. It is a consumer story. It is a dollar story. It is a gold story. And above all, it is a portfolio story. The reason ordinary people get hurt in these episodes is not that they fail to read the headline. It is that they do not understand which assumptions inside their own balance sheet were quietly depending on cheap energy, lower rates, and calm markets continuing to cooperate. Those assumptions are now under direct attack. I want you to picture the entire financial system as a giant pressure chamber. For years, the chamber stayed stable because inflation was expected to cool, rates were expected to come down, capital was expected to get cheaper, and the world believed the machinery of growth could keep humming without the cost of energy reasserting its old power. Now someone has turned a dial inside that chamber very hard and very fast. That dial is oil. And once you turn it far enough, everything else inside the chamber starts changing pressure. Consumers choke, margins compress, bond markets reprice, the Fed loses room, the dollar rises, gold behaves in ways that confuse the public, and portfolios built for falling rates suddenly discover they were really portfolios built for a world that no longer exists. That is the frame I want you to use, not fear mechanism, because once you understand the mechanism, you stop asking childish questions like, will oil really hit 200? That is not the important question. The important question is this: what has to happen to your portfolio, your cost structure, the Fed, the dollar, and the assets you thought were safe, if the market becomes forced to price even the possibility of $200 oil? That is the better question. The source document is very clear that this is about chain reaction. Not just a commodity move, it explicitly lays out the sequence from Strait of Hormuz disruption to oil supply shock to inflation to no Fed cuts to higher effective rates to lower profits and lower stock prices. That is exactly the right skeleton. I want to rebuild it into a story you can actually use. Let us begin with geography, because finance people love acting as if prices emerge from nowhere. They do not. They emerge from physical bottlenecks. The Strait of Hormuz is not a rumor. It is not a metaphor. It is a narrow artery through which a huge share of seaborne oil moves every single day. And once a critical artery becomes risky enough that insurers panic, shippers hesitate, and buyers start bidding for future supply before the actual shortage fully arrives, the market does not wait politely for the final closure. Markets price fear before closure. That is why people who think in headlines are always late. They wait for certainty. Capital prices probability. The source document emphasizes this repeatedly. The strait does not need to be fully closed for the economics to break. It only needs to become dangerous enough that tankers are hard to insure, and the market begins pricing disruption in advance. That is a devastating insight, because it tells you the problem is not whether the route is physically blocked forever. The problem is that once enough doubt enters the corridor, every buyer, trader, refiner, and government with a pulse starts behaving as if future barrels are suddenly much scarcer than yesterday. And when 20% of global seaborne oil can no longer be treated as frictionless, the price system does not move modestly. It goes looking for pain. That is what oil does in real crises. It rises until behavior changes. It rises until demand is destroyed. It rises until weak balance sheets scream. It rises until policy is cornered. That is why I do not laugh when people say $200 is possible. History does not laugh either. The source file cites prior oil shocks, including the Iranian Revolution, the Gulf War, and the Russia-Ukraine War. to show that doubling or violent repricing is not fantasy once a meaningful portion of world supply is in question. Again, the exact print is not even the main issue. The journey toward that print is enough to break a great many assumptions. This is where the average investor starts making his first large mistake. He hears higher oil and thinks only about the gas station. That is like hearing heart attack and thinking only about a sore arm. Oil is embedded in everything: transportation, trucking, shipping, airlines, industrial heat, manufacturing, cold storage, fertilizer, food production, packaging, chemicals, plastics, pharmaceuticals, commercial energy. If the cost of oil rises violently, it does not just make commuting annoying, it forces almost every business in the economy to renegotiate its margin structure at the same time. That is why I say oil is not a commodity in this context. It is a tax collector. It arrives without asking permission and takes a piece of everyone's model. The source document makes this point plainly by listing the industries and cost chains oil touches, and by arguing that higher oil means everything goes up immediately and structurally. Not eventually. That phrase matters: immediately and structurally. Because if the problem were slow and cosmetic, the Fed could look through it. But when oil begins feeding directly into the entire organism, the Fed stops looking like an institution making clean choices and starts looking like a doctor asked to treat two contradictory emergencies with the same set of exhausted tools. That is the next piece of the chain. The Federal Reserve was supposed to be the hero of the soft landing fantasy. Cuts were meant to arrive. Lower rates were meant to rescue valuations. Cheapening money was meant to help the overborrowed parts of the system survive one more cycle. That was the market's emotional bargain with 2026. Then oil showed up with a knife because the Fed cannot cut into a renewed inflation shock without looking irresponsible. And it cannot keep rates painfully high forever without breaking more of the debt structure sitting beneath the economy. That is the trap. The source file states this directly. The old bull case for 2026 rested on rate cuts. But if oil drives inflation higher, the Fed is trapped between easing into inflation and holding rates in a slowing economy. I think this is the most important sentence in the whole setup. Not because the Fed matters more than oil, because the Fed was the bridge between fear and relief in the old market story. If the bridge is burned, then everything priced off that bridge must be reconsidered. Rate-sensitive growth stocks, REITs, utilities, consumer finance, housing, private credit, commercial real estate, long-duration narratives, all of them were living, in one way or another, on the idea that the cost of money would get friendlier. $200 oil does not merely threaten that. It ridicules it. That is why I say the real event is not oil going up. The real event is the collapse of rate relief as a rescue mechanism. Once that collapses, the market must move from fantasy pricing to arithmetic pricing. Arithmetic is much less kind. Let me lay out the chain as simply as I can. Higher oil means higher inflation pressure. Higher inflation pressure means fewer rate cuts, later cuts, or no cuts. No cuts means borrowing costs stay higher than the market hoped. Higher than hoped borrowing costs mean lower profits, weaker valuation support, more credit stress, and weaker consumer capacity. Then those higher costs bleed into the very sectors that had been treated as long. Duration growth engines or fragile rate beneficiaries, that is the chain. The source text sketches it in a very direct way with the sequence from oil to inflation, to no cuts, to higher effective rates, to lower profits, and then lower stock prices. That is the kind of framework most investors need, much more than they need another dramatic thumbnail. Now let us talk about the dollar, because this is where things become even more confusing to people who learned the textbook version of crisis investing. In the childish version of the story, war means gold up, fear means safe havens up, the dollar maybe reacts, and everyone buys what sounds defensive. Reality is nastier. If a geopolitical energy shock makes the market conclude that U.S. inflation may be higher and Fed easing may be delayed, the dollar can strengthen as rates remain higher relative to expectations, and a stronger dollar can pressure gold in the short run, especially paper gold, even while the deeper reasons for owning gold are becoming more valid. This is one of those situations where the public confuses short-run mechanics with long-run logic. The source file devotes a lot of time to this exact confusion, arguing that gold's plunge makes sense. Once you understand the dominoes, oil shock, inflation, stronger dollar, Gulf selling, ETF liquidations, and leverage products forcing more selling. That is the right way to think about it, not gold failed, not safe havens, are broken. The real explanation is that forced sellers do not care about your elegant theory. They care about margin, they care about collateral, they care about raising cash. And that brings me to one of the most important distinctions in all investing. Paper behavior and physical logic are not always the same thing. The source document points out a divergence between physical and paper markets, notes the importance of Shanghai premiums, and says leveraged ETF flows turn into a wrecking ball on the way down. That is crucial. Because once leveraged retail money, margin calls, and momentum, chasing ETF structures start selling into weakness, the move stops being a clean referendum on the thesis. It becomes a liquidation event. And liquidation events have their own violent physics. If leveraged holders are down 6% in a day because the underlying moved only 2%, they do not ask whether the macro picture still favors gold over the long run. They sell because the account demands it. Then the next holder sells, then the next. And suddenly the public concludes the thesis must be wrong because the chart looks ugly. That is how inexperienced investors repeatedly hand good positions to strong hands. The source file also notes that while institutions had been selling into the earlier rally, the freshest institutional flow looked more like renewed buying after the plunge. That matters because it implies a transition from weak, reactive holders to stronger, longer horizon buyers. This is why I keep saying you must learn to distinguish between thesis failure and holder failure. Sometimes the asset is wrong, sometimes the owners were too weak. Those are not the same thing. Now, there is another mistake people make at exactly this point. They hear me say gold's collapse may be mechanical rather than philosophical, and conclude they should blindly buy gold, silver miners, and anything shiny the next morning. That would be another form of stupidity. My job is not to tell you to worship the metal. My job is to teach you to respect mechanism. If you understand the mechanism, you stop panicking. You also stop fantasizing. You begin asking better questions. What part of my portfolio is directly damaged by sustained higher oil? What part is indirectly damaged because the Fed cannot deliver the relief the market had expected? What part has genuine pricing power? What part merely looked great while capital was cheap? What part is being sold for mechanical reasons, even though the structural case survives? Those are the right questions. And once you ask them, the world of opportunity becomes narrower but much clearer. The source document S-sector discussion is actually strongest when it leaves the simplistic buy oil, sell everything else, framing and moves into differentiated effects, energy infrastructure, oil services, pricing, power companies, and selected defense. Do better airlines, rate-sensitive banks, utilities, and weak consumer businesses look more vulnerable? That is a much more serious framework. I would simplify it even further. There are 4 kinds of assets in an oil shock. The first kind invoices the shock. The second survives the shock. The third is repriced by the shock, even if its long-term structure remains intact. The fourth is genuinely wounded by the shock. You must know the difference. Energy infrastructure is a perfect example of the first category. Pipelines, storage, maintenance, toll, collector businesses, domestic logistics, oil services. These are often better ways to participate in the stress than blindly buying whatever producer already exploded upward. Why? Because infrastructure is often paid on throughput, movement, servicing, and indispensable logistics. That makes it a more durable claim on the problem. The source file explicitly favors pipelines and service companies over a simplistic chase into whatever already ran hardest, and I think that is one of the more intelligent parts of its practical framework. Yes, that is how adults think, not what already went up. What keeps getting paid if the stress persists? Defense is similar, not in the childish sense that war always equals easy money. That trade gets crowded fast. But governments do not merely react to one conflict. They reset procurement assumptions. They refill inventories. They lock in contracts. They raise long-duration spending priorities. That makes selected defense names interesting, particularly those with real budget depth behind them rather than whatever retail traders are already shouting about. Now think about the opposite end of the spectrum, airlines. What are airlines in an oil shock? They are a machine built on a cost input moving against them in one of the worst possible ways. The source document practically spits on airline economics. And while the style is theatrical, the logic is sound. High fuel sensitivity and poor economics make them structurally unattractive in exactly this sort of environment. Agreed, you do not need to moralize, you just need to understand the business model. Now consider utilities. The public often treats utilities as automatic safety. Sometimes that is true, but in an inflationary energy shock, if they cannot pass costs cleanly and quickly enough, they are not pure havens. That nuance matters banks too. This is where people get caught because banks are not only rate stories, they are also funding, cost stories, credit quality stories, duration stories, and economic confidence stories. Higher for longer rates were supposed to be manageable if the economy stayed healthier and cuts eventually arrived. Oil-driven inflation that delays cuts while slowing growth creates a much uglier version of the rate backdrop. Again, the issue is not any one rate level. The issue is the combination. That combination is what hurts. Now let me turn to technology and pricing power. This is where investors must keep their heads. If a company can raise price without losing customers, protect margins, and sit on a balance sheet strong enough to endure slower conditions, it is living a different life from a business that needed capital to stay abundant and consumers to stay euphoric. The source document mentions big tech and healthcare as examples of sectors with genuine pricing power that may have been marked down enough to become interesting rather than merely dangerous, that is right in spirit. But do not buy labels. Buy economics. Pricing power is not a sector. It is a structure. You want the businesses whose customers keep paying, even when energy, financing, and sentiment all turn hostile. Those businesses survive. Sometimes they do much more than survive. They gain share because weak competitors disappear. That is why crises often increase concentration. The strong are not just strong. They become stronger because the environment does the work of eliminating the weak. That is one of the ugliest and most profitable truths in capitalism. Now, I want to come back to gold one more time because the emotional reaction to gold's plunge is where many investors will either lose discipline or discover they never had any to begin with. The source text argues that the war is not helping gold in the short run because of the chain reaction through the dollar, Gulf selling, and leveraged ETF liquidation. But it also hints that long-term structured holders may view the move very differently. That is the correct tension. In the short run, higher oil can strengthen the dollar, delay rate cuts, and force ugly selling in the longer run. If the same oil shock worsens debt, service pressure, cornered central banks, and the fragility of the financial system, then the reasons to own hard assets may actually deepen. That is why I say the investor must distinguish horizon from mechanism. A correct long-run thesis can still be mauled in the short run by liquidation. A correct short-run read can still be wrong in the larger cycle if it mistakes mechanics for destiny. That is why I prefer humility here, not dogma. You do not need to declare the death of gold because it had a historic ugly week. You do not need to become a zealot and buy blindly because you want to feel superior to the crowd. You need to observe the pressure system, honestly. Now, let me tell you what I think the real wealth lesson is in all of this. It is not that war is good for portfolios. It is that chain reactions create mispricing. The public sees the headline and chases obvious winners or dumps everything in blind fear. The thoughtful investor asks what old assumptions just died and which businesses or assets are now being repriced too hard, too little, or in the wrong order. That is the real work. The source file ends by calling this a beautiful opportunity if you have the skill. I would phrase it more carefully, but the essence is correct. These environments are not equal opportunity pain. They are environments where understanding mechanism can produce very large differences in outcome. That is the skill, not prediction interpretation, not headline reaction, balance sheet translation, not hot take structure. And structure is what almost nobody is trained to read. So what would I do if I were trying to think properly in a world flirting with $200 oil? I would begin by writing down every holding I own and asking which old assumptions it depended on. Did it depend on cheaper money next quarter? Did it depend on strong consumer confidence? Did it depend on fuel being cheap enough not to matter? Did it depend on long duration valuation support? Did it depend on financing rolling smoothly? Did it depend on low inflation? Then I would sort those holdings by 4 groups. Invoices the shock, survives the shock, mechanically oversold but structurally alive, actually broken by the shock. That is how you create clarity. Clarity is more valuable than courage here. The people who get hurt are not just the cowards. They are the confused. Now let me leave you with the image I think matters most. Imagine your portfolio as a city built on assumptions. Cheap energy is one bridge, lower rates are another, stable inflation is another, reliable margins are another. A shock like this does not need to bomb the whole city. It only needs to destroy enough bridges that traffic can no longer move the way your map assumed. That is where most investors fail. They keep using the old map after the bridges are gone. The contract I would make with my future self in this environment is simple. I will not confuse a commodity spike with an isolated event. I will follow the chain reaction from oil to inflation to rates to profits to balance sheets. I will not mistake forced liquidation for thesis death. I will not chase whatever already had the first emotional move. I will study who invoices the shock, who survives it, who is wrongly repriced by it, and who is genuinely broken by it. I will respect the dollar, the Fed, and gold as parts of one pressure system rather than separate television segments. And I will remember that the most expensive financial mistakes in crisis periods usually begin with one childish thought. This time is confusing. It is confusing only if you stare at the smoke. If you study the pressure chamber, the mechanics are hard, but they are not mysterious. And once you see them clearly, the market stops looking like chaos and starts looking like a transfer machine. That is when intelligent positioning begins. That is when panic becomes information, and that is how you stop being one of the people the chain reaction destroys and begin becoming one of the people who read it faster than the crowd.